Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, and the gold markets for Tuesday, June 28th. In some of our recent US dollar index and euro currency technical blog and webcast updates, we've discussed the market's return to the upper recesses of the past couple of months range, where we've warned to be watchful for any kind of bearish divergence in short-term momentum that might turn the market south again and to at least the lower recesses of the range, and quite possibly a resumption of the secular bear trend in the US dollar. And in fact, by virtue of this morning's failure below the 75.04 corrective low from Friday, the market has confirmed a bearish divergence in short-term momentum that has minimally reaffirmed the 76, the figure area, as stiff resistance. And given the fact that on a daily chart shown here, the fact that this market has again rejected the upper recesses of the past couple of months range, at least for the time being, this short-term weakness reinforces or gives greater weight to the broader bearish prospect that all the price action up from the May 4th low at 72.69 is bear market corrective, ahead of either a relapse to the lower recesses of this consolidation range, or quite possibly a resumption of the secular bear trend shown here on a weekly log close-only basis. Indeed, the market's continued existence below former support from last November around the 76.50 area as now new resistance, and the fact that the market has barely been able to retrace even 38.2%, a Fibonacci minimum of this year's sell-off, all contribute to a broader bearish count. And again, by virtue of today's short-term weakness that defines at least recent highs at 75.99 and 76.02 as resistance and tight risk parameters, the market, until the market can recover above those levels, we don't know that the market won't be either returning to the lower recesses of the past couple of months range or quite possibly resuming the secular bear trend. These issues considered, the traders are advised to move back to a cautiously bearish policy with strength above 76.02 required to negate that. In lieu of such strength above 76.02, we anticipate at least a retest of the lower recesses of the past couple of months range and quite possibly a resumption of secular bear trend and new lows below 72.69. Moving to the euro currency, and conversely, by virtue of overnight strength above the 143.07 corrective high from Friday, the market has likewise confirmed a bullish divergence in momentum that reinforces the recent 140.74 low from 16 June, and especially coming from the lower recesses of the past couple of months range, reinforces this support and increases the prospect that all the price action down from the May 4th high at 149.44 is likely corrective consolidative ahead of resumption of the secular bull trend. You can see the developing lateral triangle pattern as a prospect, a consolidative prospect that, on the heels of the broader bull trend shown here on a weekly log close-only chart, really contributes or reinforces the odds that all this price action over the past couple of months is merely consolidative, and that ultimately would be expected to yield to a resumption of this bull trend to new high weekly closes above 148.07 and high intraday prices above 149.44. These issues considered, traders are advised to move to a cautiously bullish policy with weakness below at least 140.74 and preferably 139.69 required to defer or threaten this bullish count. Finally, as a possible inverse correlation consequence of the renewed pressure on the US dollar index, we want to be watchful for any kind of short-term basing and reversal price action in the gold market that could re-expose the secular bull trend. And we think by virtue of some waning downside momentum on a very short-term basis, especially from the recent low at 14.90, the market could be on the cusp of an outstanding risk-reward buying opportunity, base and reversal, and quite possibly a resumption of the secular bull trend. We think it's interesting to point out on a very short-term basis that the rate of change measure of market momentum shows a waning in downside momentum. That, again, on a very short-term basis, if the market can recover above yesterday's 1506 spot 10 high that would confirm this divergence, again, on a very short-term basis, that we believe might be worth taking the risk of an outstanding risk-reward trade, because if the market does provide better strength above former support, new resistance in the 1511, 1512 area, we think the market could be on the cusp of a resumption of the long-term bull trend and new highs above not only last week's 1560 high, but quite possibly the all-time high above 1577. For an approximate $500 risk on a mini-gold contract, the risk-reward we think could be outstanding. But the 1490 spot 80 low from yesterday could prove important for a couple of Fibonacci progression relationship reasons. We think it's important to point out that at 1488 spot 80, the past week's sell-off attempt has spanned a length exactly 1.618, that of the preceding sell-off attempt from 1555 to 1511 spot 40 earlier in the month on this intraday basis. Also, on a daily log scale active continuation chart basis, you can see the developing potential for a lateral triangle pattern. If you take the initial counter trend move in early May from 1577 down to 1462, multiply that by 0.618 for a 61.8% progression from the mid-May high at 1559. That projects to the same area at 1488 spot 10. If the market can confirm at least a short-term bullish divergence in momentum enough to stem this most recent sell-off and define a more objective low and risk parameter at whatever low is left in its wake, we think that could provide an outstanding risk-reward trade for an eventual resumption of the secular bull trend. Until or unless the market can strengthen above at least 1506 and preferably above the 1511, 1512 area, we must be leery of this downtrend being attacked, and further losses should not surprise. From a mini gold contract perspective, you can see the developing importance of that 1506 spot 10 high. The market's pressuring it right now. We advise traders along this pure risk-reward lines to establish a cautious bullish exposure on the immediate break above 1506 spot 10 and use the rejected low at 1491 spot 10 as the risk parameter, about a $500 risk to that bullish exposure. And if this market can prove continued trendy impulsive strength thereafter, we think that ultimately will expose at least a steeper recovery to the recent sell-off and quite possibly a resumption of the secular bull trend. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.